Okay guys, welcome back to another video. It's been an unbelievably busy few weeks, especially this past week in the markets. There's just a lot going on. Today, specifically, I wanted to talk about the Japanese yen and the recent strengthening we've seen against the US dollar. And there's a few real key points that are worth exploring today. We're going to talk about the upcoming Bank of Japan meeting in a week's time, and also where the carry trade is heading and what we're seeing on the US Treasury side. So we've been tracking the 30-year US recently, and it's interesting to me that the dollar is falling for now against the yen. So, there's a lot of interest in terms of so-called currency intervention by the Bank of Japan, selling off a lot of US treasuries to buy potentially more yen. You couple that, with the speculation about rate hikes before Bank of Japan policy meeting next week, it starts to get interesting. Of course, there's big issues, and we'll touch on that later in the video in terms of if the Bank of Japan starts aggressively raising rates, perhaps higher than what is expected, there are implications for the US markets in general, money markets, stock and bond market, and there would then be no more yen carry trade, which has been a bit of a money earner for quite some time now. You have to think about how much money would potentially leave stocks and bonds if the yen carry does go away. So for those that don't know, let's just break down the yen carry, which is basically this free money hack that's been going on for a few decades now. Ever since the Japanese, stock, real estate markets crashed at the end of the 1980s. If you think about a result of that crash, what we've actually seen is that the Bank of Japan lowered rates to ultra low levels. We've only recently come out of negative interest rates, and it's allowed for extremely cheap borrowing of the yen. It's still extremely cheap, although not as much by historical standards anymore. We're just potentially entering a new transition period. And of course, these very low interest rates have caused the yen to weaken against foreign currencies in pretty much a consistent and ongoing matter. And it's been accelerated this past two and a half years, partly because we've had commodities, a bit of a bull market in commodities that's affected Japan badly. But what you've essentially seen on the breakdown of the carry trade is investors would borrow yen from Japanese banks at extremely low rates. They'd convert the yen to whatever their local currencies are, usually US dollar, and use those dollars to invest however they like. And typically what you'll see is every month the loan service monthly payments would be paid by exchanging US dollars back into yen. And usually you'd pull the profits from the investments that were originally made with the borrowed Japanese yen. And we have to remember that the yen is, it's been weakening against foreign currencies now for a very long time. And when we actually look at, year by year, the exchange rates, they've just got better and better. So, on paper, you'd need less dollars to convert to yen to come up with your monthly loan payment. So that's the yen carry trade. That's how it works. That's how it's historically worked. And it's given people an opportunity to make almost risk-free money. The big question now, with the decline in the real rates of dollar yen, we can just see here the beginning of the decline. The move that we've had from 160, just shy of 162 down to 152 last week, and the bounce now of about 200 points. We're hovering around 154. We'll break that down. Obviously, still the yen is extremely weak against the US dollar. How much weaker can we go? Is 162 the top? We've still got our long positions on dollar yen actually, but if we get much weaker, how much can it affect the Japanese economy, and it's, you know, a lot of its people will not be able to survive. Remember that Japan relies on imports of energy and other commodities to survive. So there is talk that the Bank of Japan will be ending, you know, this cycle that we've had for a number of years, and the rate hikes are going to begin to pick up speed. If that happens, there's big issues, as I say, for the US markets. First of all, it will make the yen a lot more expensive to borrow, which would begin to ruin, you know, the first half of the yen carry trade. Anyone that's been doing that trade recently is going to be in trouble. So it's going to be interesting to see, you know, if higher rates, what they're going to cause, you know, potentially money to go to Japanese government bonds, more money going there into JGBs. And if that's the case, you know, being converted to yen prior to buying JGBs, that demand for yen would stop the weakening of the yen potentially against other currencies. And then that's an issue. The problem is there's a lot of money in investments that around the world that were funded by borrowing yen because of this yen carry trade. So without a weakening yen, the monthly loan payments get a lot more expensive. So any existing investments will start to be liquidated. And without low rates, it becomes very expensive to borrow the yen in the first place. So you've got no more liquidity coming into the system from borrowed yen, which is a big issue. The biggest issues from this is the American markets, because the majority of the yen loans have been going into US dollars. There's been talks of the yen going into exotic markets, exotic bonds, but it's very difficult to get currency exposure and hedges on exotic pairs at that point. So the situation now is really how I would describe a bit of a ticking time bomb, and you know, that could be the catalyst that brings down the markets. In terms of how far we correct, it's very difficult to say at this stage. It all depends on what the Bank of Japan does. If they decide to raise rates to basically save themselves, keep their own citizens from hyperinflation, or keep interest rates low to save broader markets at the expense of their own people. So we will see what Japan does. Next week we've got a meeting. They're not expected to hike then, but of course, you know, we're going to see what happens. So be very cautious. I personally am in the camp that believes that the Bank of Japan will move slowly and it won't necessarily shock global markets. But, you know, we've seen the Bank of Japan act as almost like the Fed's wingman for a very long time. So it's hard to see that to stop now. There's also implications for US mid long-term bond funds. You know, for one thing, if local Japanese investors can get a decent return on Japanese government bonds, that might mean that they pull out US Treasury holdings, and they could put that money to work in JGBs instead, buying it with, of course, the yen. And that would basically mean that the yields would potentially tick higher on US Treasuries, and the price would go down. So, you know, also, you know, if you start to raise JGB rates, interest rates, it's not the only way for, you know, Japan to save the yen. They could also sell their US Treasury holdings. We've just had an auction where there's been a decent amount that's been sold off, a decent chunk. Hasn't really hit the market yet though. So there's a lot that's going on, and just as I say, I'm advising people to be cautious. And Japan is a little bit of a dark horse. It's got the ability to really affect the markets if it needs to. Everyone is sort of watching nervously. People that have been trying to time the unwinding of this trade for a long time, from the 130s, 135s, you know, we got into the 160s. We're now just under 154. So, you know, you have to keep that in mind. But when you look at the culture of Japan, they are typically insane savers. their, you know, decade-long fiscal policy has forced trillions of investment money into foreign markets, mostly, as I say, the US markets. So it's quite interesting to see. And if they start giving the Japanese a way to invest and make money domestically again, then why would they not jump into that? And even worse, you know, an even worse scenario is if there is some kind of, you know, push to bring money back home, it would cause a crash in all US markets. So hedging to the downside at this point is pretty critical. But people have been early, people have been wrong. This is not financial advice. This is my opinion and the way I'm trading the markets. So let's see what happens. So that's just a quick video for me talking about, you know, what we're seeing in the Japanese markets at the minute, where there's pockets of opportunity. We've been long dollar yen for a long time now, and we haven't fully unwound the position yet. So there's a lot of opportunity for good quality trades out there, for traders who are patient, have got the risk tolerance and the money management skills. Okay, that's another video from me. Hope this is helpful. If it is, give it a thumbs up and a comment. I don't have any production value. I just point it with my phone and record. So I hope you enjoy, guys. Cheers.